All right, so today we're going deep on risk metrics, and hopefully by the end of this, you'll feel comfortable enough to navigate all the ins and outs and really get a feel for it.
Yeah, it's definitely a powerful tool.
We're working from the risk metrics technical document here, and let's be real, it's
Dense.
yeah, it's dense, very technical.
Yeah.
But we're here to kind of distill it down to the essential parts.
Yeah, we're going to mine the gold from it.
Exactly.
So let's get right to it. What is RiskMetrics? What's the big idea?
So at its core, RiskMetrics is a system for forecasting potential losses in your investment portfolio.
Okay.
And we can think about it as quantifying the likelihood of different outcomes for your investments.
Okay, so why should I care about this? Why is this something that should matter to me? Yeah, I mean, particularly now more than ever, financial markets are constantly evolving. They're becoming more volatile, more interconnected.
Yeah.
And really, risk management today isn't just about seeking profits, but it's also about mitigating potential downsides.
Right.
And that's really crucial for anyone who's operating in today's financial landscape.
Yeah, so it's about making informed decisions. It's not just about trying to avoid risk altogether.
Precisely.
And I see here that, to do that, we need to understand things like volatility and correlation.
Absolutely. And as we'll see in the document, those are central to how RiskMetrics works.
And the document mentions volatility quite a bit.
Yeah.
So what exactly is that? How can we think about that?
So you can think about volatility as how much an asset's price fluctuates or moves up and down. A highly volatile asset would be like a roller coaster ride.
Yeah.
You might experience some exhilarating highs, but you also might experience some stomach-churning drops.
Right. And so that makes me think of the term standard deviation.
Absolutely.
How does that play into this?
Yeah, so standard deviation is actually the precise statistical measure that RiskMetrics uses to quantify volatility.
Okay.
So a higher standard deviation means there are larger price swings and thus higher volatility.
So more risk potential.
Potentially, yeah, but you also have to keep in mind very often risk and reward go hand in hand.
Right, of course.
And then the document also dives into correlation, which is how the prices of different assets move in relation to each other.
So if two assets have a high correlation, their prices tend to move in the same direction.
Exactly. It's like two dancers moving in sync with one another.
Okay.
And understanding correlation is key because it affects how RiskMetrics analyzes the overall risk in your portfolio.
Gotcha.
Now, to actually go about forecasting risk, RiskMetrics uses a method called exponentially weighted moving average.
That sounds a little intimidating.
Yeah, it sounds a lot more complicated than it is.
Okay.
It's really just looking back at historical data, but giving more weight to more recent events when predicting future risk.
Okay.
So you can think about it as like how you remember the news more vividly from last week versus something that happened 5 years ago.
Okay, so past behavior offers clues about potential future behavior.
Exactly. And then as far as applying that to your finances, you'll see the document mention cash flow mapping.
Yeah, what is that?
And really what that is, it's just plotting when you expect income to come in and when you expect expenses to come out.
So it's visually mapping out your finances across a timeline.
Yeah, exactly. And then RiskMetrics analyzes those cash flows in light of those potential market movements.
Okay.
And by understanding where your exposures lie, you can make more informed decisions to try to mitigate those potential losses.
To minimize your risk.
Exactly. And the document actually gives some good real-world examples of how that works in practice.
Okay, so we've been talking about all this stuff in theory,
Right.
but the document also mentions specific financial things like government bonds, forward rate agreements, options.
Right.
What does it actually look like to apply risk analysis to some of these instruments?
Yeah. So let's take the example of a forward rate agreement. So let's say you're looking to lock in an interest rate for a loan that starts, say, 6 months from now.
Okay.
RiskMetrics would look at potential interest rate changes over that 6-month period and calculate how much you could potentially gain or lose based on how those interest rates fluctuate.
So it's like running simulations almost.
Yeah.
But instead of using, crystal ball, we're using data and algorithms and stuff.
Exactly. And the really interesting thing about RiskMetrics is that it doesn't just look at the risk of any one particular asset in isolation.
Right.
It looks at how those assets are correlated with one another within your portfolio
Yeah, that makes sense.
to give you a more holistic risk assessment.
But one thing that stood out to me is the document did say that RiskMetrics can sometimes overestimate risk.
Right.
What contributes to that? Why is that?
Yeah. And it's important to keep in mind no model is perfect.
Right.
One thing is the pull-to-par effect.
Okay.
So as bonds get closer and closer to their maturity date,
Mm-hmm.
their prices naturally gravitate towards their face value.
Okay.
And RiskMetrics, being a statistical model,
Yeah.
doesn't always perfectly capture that more nuanced behavior.
Okay.
So that can lead to a little bit of overestimation of risk, particularly for portfolios that are heavily weighted towards bonds.
So you really have to understand both the power and the limitations of a tool like this.
Absolutely.
So if you had to pick just one key takeaway that you want our listener to walk away with after this deep dive, what would it be?
RiskMetrics can definitely give you a much deeper understanding of the potential risks that you're taking in your investments, but it's not going to eliminate uncertainty entirely. It's really about leveraging the insights that you can get from data to make more informed decisions.
Right. So it's not about predicting the future with 100% certainty.
Exactly.
It's about having more information to make better decisions.
Yeah, it's like having a more detailed map when you're navigating the sometimes turbulent waters of financial markets.
Yeah.
It gives you a better lay of the land, but you still have to chart your own course.
Exactly. And one thing I think is really interesting that you touched on is this idea that, like, the document focuses a lot on statistical analysis,
Right.
which is obviously super important. But then there's also this human element,
Absolutely.
right? Like market sentiment, investor psychology, all these things that can't necessarily be captured in an algorithm.
Yeah, that's a whole other layer.
Yeah. So today we've unpacked a lot, I think.
We definitely have.
We've taken some really dense, complex concepts and broken them down, looked at real-world applications, and even talked about some of the limitations of this tool, which I think is always important.
Definitely.
So hopefully you feel a little bit more equipped now to go out there and start navigating the world of financial risk management.
Yeah, go forth with confidence.
Exactly.
Yeah.
But remember, this is just the beginning. Keep learning, keep exploring, and we'll see you in the next deep dive.